Most of life's biggest financial outcomes don't come from steady, predictable progress. They come from rare, extraordinary events, the outliers that shape everything. One big investment, one lucky break, or one unexpected innovation can outweigh dozens of average results. In this chapter, we'll explore why tails, the unlikely, the surprising, the extreme, often decide who wins in money and in life, and how understanding this truth can change the way you approach risk and opportunity. The power of outliers. When we think about success, whether in money, business, or life, we often imagine it as the result of steady, consistent progress. Step by step, year after year, small gains eventually add up. And while there's truth in that picture, it hides a deeper reality. Most of the biggest results don't come from steady progress at all. They come from outliers, from rare, unpredictable, extreme events that shape the course of everything that follows. In finance, these are called tail events. The term comes from statistics, where the tail of a probability curve represents the rare, far-out outcomes. The things that don't happen often, but when they do, they matter enormously. And history shows us that tails drive almost everything. Take the stock market, for example. Over the past century, the majority of market gains have come from just a handful of companies, giants like Apple, Amazon, Microsoft, and Coca-Cola. Most businesses underperform or fail altogether, but a few winners grow so explosively that they lift the entire market. If you missed owning those few outliers, your returns would have looked dramatically different. One or two tails outweighed thousands of average performers. The same is true in venture capital. A fund might invest in 50 or 100 startups, and most of them will struggle or quietly disappear. But the entire portfolio can be made wildly profitable by a single breakout success. One Uber, one Airbnb, one Google, and suddenly the risks and losses of the others hardly matter. The tails define the game. Even in personal life, the same principle applies. Think about your own story. Out of all the days you've lived, it's likely just a handful of decisions, opportunities, or encounters shaped the majority of where you are today. Meeting the right person at the right time, landing that one job or client, saying yes to an opportunity that seemed small but opened huge doors later. A few tail events set the course for decades. This pattern isn't limited to money or careers. It shows up everywhere. In science, breakthroughs don't come from steady progress across the board. They come from rare discoveries. Penicillin, electricity, the internet, DNA. These tail events rewrote what was possible. In sports, entire careers are defined not by average performances, but by a handful of spectacular wins, moments that cement legacies. What makes tails so powerful is not just their rarity, but their disproportionate impact. They remind us that the world isn't a neat, predictable place. Instead, it's uneven and messy, where a small number of events produce the majority of outcomes. This can be unsettling because we like to believe that every action counts equally, that steady effort guarantees steady results. But reality is lopsided. A few moments carry the weight of a lifetime. Understanding this changes the way we think about wealth and risk. It means we can't judge success solely by averages or short-term outcomes. Missing one tail event or failing to protect ourselves from a negative one can change everything. It also means that patience and persistence matter more than we realize. You don't need constant, spectacular wins. You just need to stick around long enough to catch the few extraordinary opportunities when they appear. In the world of money, tails are the rule, not the exception. Recognizing their power doesn't make life more predictable, but it does make us wiser. It helps us respect uncertainty, stay humble about our successes, and focus on positioning ourselves to benefit when the rare, extraordinary events arrive. Why averages mislead us? When people talk about investing or success, they often quote averages. The stock market returns an average of 10% per year. A certain industry grows at an average of 7%. On paper, averages give the impression of predictability, stability, even fairness. But averages are misleading. They hide extremes. They smooth over the extraordinary events, the tails that actually drive most outcomes. Consider the stock market again. Yes, over decades, the average return may be around 10%, but that doesn't mean every stock, every investor, or every year performs that way. Most stocks underperform the index. Some go bankrupt. Only a few winners generate the bulk of the gains. Apple, Amazon, Google, these outliers shape the average. Without them, the average return looks entirely different. If you ignored these tails, you'd assume the market is flatter, safer, and less rewarding than it really is. The same is true for businesses. Suppose you look at the average profit of companies in an industry. Averages suggest steady growth and modest rewards. But in reality, a handful of companies capture most of the market share, leaving the rest struggling. One Tesla can dwarf the returns of dozens of smaller electric car companies combined. One Netflix or Disney can define an entire sector. Most businesses contribute very little, but the few big wins create the appearance of steady averages. This is why relying on averages can be dangerous. They lull people into overconfidence, making them believe that past results predict future outcomes. If most of your returns come from a few rare events, it doesn't matter how consistent the rest of your performance appears. Missing those key moments or being exposed to a catastrophic negative event can drastically alter your reality. The average can give a false sense of security, masking the true risks and opportunities. Even in personal life, averages mislead. Consider education, careers, or earnings. Many studies report average income growth, promotions, or achievements. But most people don't experience the average. A handful of outliers, someone who invents a breakthrough, lands a unique opportunity, or inherits wealth, distort the average. If you plan your life by expecting average outcomes, you might be preparing for a reality that rarely exists. Recognizing the skewed nature of averages changes decision-making. Instead of assuming stability, we prepare for extremes. Instead of expecting steady returns, we focus on positioning ourselves for the rare wins and protecting ourselves from rare losses. Averages can guide us in theory, but tails guide us in practice. Understanding this distinction is what separates those who survive and thrive in unpredictable environments from those who are caught off guard. Let's look at venture capital. The average startup fails. Most return little or nothing, but a tiny fraction achieve massive success. A fund's overall performance is not shaped by the median outcome, but by the few extreme wins. Ignoring these outliers would make investing appear hopeless. Instead, the savvy investor designs a portfolio to capture the possibility of these rare, extraordinary outcomes while mitigating the inevitable losses. Averages also mislead in risk assessment. People often underestimate the probability of extreme outcomes because they rely on the normal or expected scenario. This is why many financial crises seem sudden. They weren't, but most people ignored the tails. Catastrophic losses like the 2008 housing crash didn't affect every mortgage equally, but their extreme impact reshaped entire industries and erased fortunes in ways that average figures couldn't predict. In short, averages are convenient, but they're deceptive. The real drivers of success are the extremes, the outliers, the rare events that lie in the tails. The lesson is to focus less on what usually happens and more on what can happen, both positively and negatively. To build wealth, to thrive in business, or even to make strategic life decisions, you need to understand the outsized power of rare events. They are the ones that truly determine the outcome, not the smooth, predictable mean. Embracing uncertainty in extremes. If tails drive outcomes, then understanding and embracing uncertainty becomes essential. The world is not neat, predictable, or fair. Rare extreme events, both positive and negative, have disproportionate impact. And yet most of us behave as if the future will unfold smoothly, as if averages tell the whole story. To win in life and wealth, we must think differently. Embracing uncertainty begins with mindset. Accept that you cannot predict everything. Rare events, by definition, are unexpected. Trying to forecast the timing or the scale of tails is often futile. Instead, focus on positioning yourself to benefit when they occur. This means keeping flexibility, maintaining optionality, and staying ready to seize opportunities or survive disasters when they appear. Take investing as an example. Many people try to forecast which stocks will outperform, which industries will boom, or when the next crash will hit. While research helps, the most successful investors often rely less on prediction and more on preparation. They design portfolios that can capture massive gains from a few big wins, while limiting exposure to catastrophic losses. They embrace the uncertainty rather than pretend it doesn't exist. This mindset also applies to business. Entrepreneurs cannot predict which product will become a hit, which trend will take off, or which competitor will fail. The smart founder accepts that most attempts will fail, but structures their work so that one success can outweigh many failures. In this world, surviving the extremes and being ready for the rare opportunity matters more than trying to hit every small target perfectly. The same principle applies to life in general. Most experiences, career growth, relationships, personal achievements, don't follow a straight line. Rare events, moments of serendipity, and even crises can define entire trajectories. By embracing uncertainty, you stop fearing randomness and start seeing it as the engine of possibility. You learn to expect the unexpected and to treat rare events not as anomalies, but as the primary drivers of outcomes. But embracing extremes is not just about chasing upside. It's also about protecting against downside. Positive tails can create fortune. Negative tails can destroy it. This is why risk management is crucial. Avoid bets that can wipe you out completely. Build buffers. Diversify. Maintain resilience so that when the rare disaster hits, you survive and remain in the game. History is full of examples. Entrepreneurs who lost everything in one venture often went on to build fortunes in another, because their previous failures taught them how to manage risk, survive, and seize opportunities. Investors who preserved capital through downturns were able to capitalize on rebounds. The tails, both positive and negative, determine long-term success, and the difference is whether you are prepared to embrace them rather than be crushed by them. There's a paradox here. The more extreme the potential outcome, the less predictable it is, and the more you need to be prepared for it. Embracing uncertainty requires humility. You acknowledge that luck, randomness, and events beyond your control shape much of life. Yet you also act decisively, knowing that rare opportunities often reward those who are ready to act. It's a mindset of respect for chance, combined with readiness to act when the improbable occurs. This approach changes how you make decisions. Instead of focusing on incremental improvements or predictable outcomes, you focus on creating situations where rare wins can compound and rare losses can't destroy you. You embrace the power of tails and structure your life to maximize the chance that one extreme event, positive or negative, becomes transformational rather than catastrophic. In the end, embracing uncertainty is about understanding that life is driven by outliers. It's about positioning yourself for rare, extraordinary events rather than trying to make every step predictable. Positive tails reward patience and preparation. Negative tails punish overconfidence and negligence. By respecting both, you turn randomness from an enemy into an ally, and you begin to see why sometimes just one rare event can define your future. Positioning yourself for tails. Now that we understand the power of rare events and the skewed nature of averages, the question becomes practical. How do you position yourself to benefit from tails? How do you structure your life, your work, and your finances so that one extraordinary event can have a transformative impact while protecting yourself from catastrophic losses? The first principle is survival first. You cannot capture rare upside if you're wiped out by rare downside. Think of it like flying in a storm. You want to chase the winds that could carry you to great heights, but you need a sturdy plane that can withstand turbulence. In financial terms, this means keeping your fixed expenses manageable, avoiding catastrophic leverage, and maintaining flexibility so that a single unexpected event doesn't destroy everything you built. Your goal is to survive long enough to catch the big opportunities. Second, maximize optionality. Optionality is the freedom to act when rare events occur. It's about positioning yourself in a way that allows you to take advantage of opportunities without committing everything to a single outcome. Entrepreneurs create multiple projects, investors diversify across industries, and innovators explore multiple ideas simultaneously. Optionality doesn't guarantee a tailwind, but it increases the chance that one of your bets becomes extraordinary. Third, be patient. Rare events don't happen on a schedule. They often come when you least expect them, or when conditions align perfectly. You can't force them, and you can't predict exactly when they will appear, but you can stay prepared. Staying in the game, building skill, maintaining resilience, and being ready to act when the opportunity appears is the essence of benefiting from tails. Time is the ally of the prepared. Fourth, think asymmetrically. Many of the most powerful tail events have asymmetric payoffs. A small investment of time, effort, or capital can result in massive returns if it hits. This is why venture capital is so compelling. Most investments fail, but a single success can pay for dozens of losses. Seek opportunities where the downside is limited, but the upside is enormous. This is how you tilt the odds in your favor, even in an unpredictable world. Fifth, expect volatility. Tails aren't smooth, they are extreme. You will experience setbacks, swings, and uncertainty. Emotional discipline is critical. The people who benefit from tails are those who can stay rational under pressure, avoid panic, and act decisively when conditions favor them. Emotional reactions to volatility often destroy wealth before rare opportunities even appear. Another lesson is diversify intelligently. While optionality is key, spreading yourself too thin dilutes the impact of your efforts. Focus on a mix of high-potential areas, but maintain enough depth in each to act meaningfully when a rare event arises. In other words, balance breadth with the ability to capitalize effectively. Finally, embrace learning and adaptation. Rare events are not always repeatable, and what worked once may not work again. The ability to reflect, adapt, and reposition yourself continuously increases your likelihood of catching future tail events. Those who cling rigidly to past successes often miss the next extraordinary opportunity. Positioning for tails is both a mindset and a strategy. It's about respecting the unpredictable nature of life, preparing for the extreme, and structuring your actions so that when the rare and extraordinary occurs, you are ready to benefit. It's about combining patience, flexibility, and courage, knowing that while most days will be ordinary, a single tail event can define your entire trajectory. In short, life rewards those who understand the outsized impact of rare events, who survive the storms, and who position themselves to capture them. By applying these principles, you don't just react to chance. You set yourself up to win when chance inevitably appears. As we close this chapter, the key takeaway is clear. Rare, extraordinary events often shape the course of our financial lives far more than the steady progress. Survival, optionality, patience, and the ability to act when opportunities arise are what allow us to benefit from these tales. But understanding and capturing rare wins is only part of the story. In the next chapter, we'll explore a different kind of wealth, freedom, how to design your life so that your time, choices, and energy are truly yours, and how financial success can serve the life you actually want to live.